Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Spotify. So Spotify just reported their Q4 results and Q1 guidance. We're going to go through that. Spotify is a stock that's quite controversial. There are bulls and bears on the two sides of the equation. And this quarterly result isn't one that's going to break the fence and going to move people to go from the bull to the bear side, or from the bear to the bull to from the bear to the bull, or from the bull to the bear. It was really quite down the middle. I mean, the stock also has been selling off. This has been something of a theme over the last several 2-3 months. And the after hours reaction, the stock is down approximately 10%. There's just been mass carnage around the mid and small cap stock. So that in and of itself isn't such a big deal. There is a lot here more that is worth picking apart. So Spotify pulled out its annual guidance. It's just gonna be focusing from now on its quarterly guidance as a way to align investors to more of a long-term thinking. The Q1 guidance is pointing to approximately 13% year-over-year growth rates. Given that Q1 of last year was the easiest quarter, the remainder of the year is going to be quite tough for Spotify, and I can understand why they would want to pull the guidance. Investors are going to be quite worried here. Okay, how are you going to compare against the really tough comps towards the back end of the year, particularly H2 2022? That being said, keep in mind that they're not really necessarily lowballing estimates, because you can see here these are the surprises that against the consensus, against their own guidance as well, that Spotify has reported over time. So you can see it's really a mixture of beats and misses. So with that in mind, it's not the type of company that's lowballing and you're going to be like, oh, they're lowballing and they're going to just smash through. They don't always smash through. So just want to kind of highlight that. The other thing to remember is that Spotify's guidance for Q1 includes 3% of tailwinds from from currency exchange movements. So if you remove that out, you're kind of looking at a business that's growing approximately just barely double digits. So it's not really a high growth story. For their part, during the earnings call, Spotify contended that they have what it takes to grow at approximately 20% compounded annual growth rates over the long term. So the fact is that that's up for there's a lot of questions whether they can indeed reignite the revenue growth rates to go from approximately 10% to 20% consistently. So I put that out there, you take it if you want. The other thing is that the MAU guidance, the monthly active user guidance numbers, came in at 418 million compared to what the consensus was looking at 422. That's just 1% shy of the consensus. But given how investors had reacted to the Netflix story just about a week ago, with that in mind, I felt that any kind of miss on that number, people would have really overreacted, because the market has been quite a jittery. It's been just primed for a sell-off. And the fact that they missed, investors the stock is down 10%, isn't that big a deal, I don't think. Also, there's the question mark of how Spotify is going to compare as it comes against the tougher comps since the onset, really, of COVID. Also, the question mark here is whether the number one podcaster, and the controversy around that will lead to an elevated amount of churn. And as you would expect, during the earnings call, they were very kind of dismissive. They're like, oh yeah, we will try to support of artist creation, and we're going to be balancing that for the safety of all our users. Nothing really no weight really given to that. And yeah, so for all intents and purposes, when the question came up later on in the earnings call and they asked, will the elevated churn be accounted for in the figures for Q1? They said, okay, we're not expecting any further elevated churn, and if we do see some, we're not going to see it in the next several days. We'll see it over time. So don't worry about it. You guys are overreacting here. So with that in mind, I don't think that it's really, when it comes down to it, we're really looking at a business that's kind of flourishing. It's you can have your own point of view on this, but from my perspective, it's gonna come down to this, right? So the business it's just not generating that much free cash flow. So yes, you could say, okay, free cash flow was up 39% year over year. Great, fantastic. But we're looking at free cash flow margins of 3%. It's really tight. Um, for their part, during the earnings call, Spotify said, we are going to expand our gross margins and we're going to talk to you in Q2 at the analyst day. We're going to say how we're going to go to 30 to 40% gross margins. Now, keep in mind that the highest gross margin that Spotify has seen is 28.4%, and this quarter just reported was 26.5%. So if they can talk a story, pull out a narrative that they're going to be growing and they're going to have gross margins above 30%, and they can back that up with a few quarters of evidence, I suspect the stock would quite quickly re-rate on that event. And furthermore, as I noted already, the stock is priced quite cheaply, so it's priced at 2.4 times sales. So clearly, if you consider that the business has approximately 2.4 billion net of cash, that means 6% of its market cap is made up of cash. So paying just 2.4 times forward sales seems really cheap. Furthermore, you can see here in the graph, this is the multiple that people have been paying for the stock, and right now at 2.4 times forward sales is the cheapest it's been for 18 months. So does cheap necessarily mean undervalued? That's the question. And it's a tough one because, as I already discussed, the business here, it's just, it's never going to be really trading at a very high premium because it's not a highly free cash flow generative business. So, and also, everything circles back. Can they really continue growing at approximately 20% compounded? And the evidence kind of is not, it's light, so it's tough. It's a tough one, this one here. And yeah, I hope that what I've added to you has been quite helpful. And yeah, don't forget to check out my marketplace to find out which stocks I'm particularly interested in right now. The marketplace name is right there, Deep Value Returns. Thank you for listening. Bye bye.